Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. The Trump administration slapping a $100,000 application fee on the H-1B visa program in a move that would drastically increase the cost of visas for some of America's largest companies. Plus, a U.S. congressional delegation arrives in China for talks with President Xi Jinping's government. It marks the first official visit of the sort in 6 years. The world's largest economies edge closer to a trade deal. And the UK, Canada, and Australia have formally recognized a Palestinian state, with France set to follow later today, joining a growing global consensus ahead of this week's UN General Assembly meetings in New York. Lizzy.
Well, Kriti, we're heading into the week with US stocks at all-time highs, boosted by the expectation of more Fed cuts to come and the sentiment lifted after that Trump-Xi call. But futures pointing a touch lower on both sides of the Atlantic this morning. The dollar gaining for a fourth straight day. So on the flip side, euro-dollar a touch weaker here. And with a busy week of data ahead and 17 Fed speakers on the docket, currently the 10-year US Treasury yield at 413.89. The countdown to the opening trade starts right now.
Monday morning, good morning. Are you ready for another week? We've got a lot on the docket. We've already talked about some of the things that we're going to be focusing on. There's plenty of Fed speak this week. There's a bit of data that we need to focus on. And there's always, as ever, in this Trump administration, plenty of surprises. The latest tech visas. I didn't see this one coming, nor did the tech industry, I think, and it caused consternation over the weekend. Just another wrinkle in the labour market in the United States, just to make it even more confusing, and something for the tech industry to handle. It also, I think, focuses the spotlight once again on India.
It does. It does. A good chunk of, I would say the majority of holders from the H-1B visa program come from India. And a lot of that is the tech boom that dates back to the 90s. But we look at the companies themselves that are affected. We're talking about Amazon, Microsoft, Alphabet, many others. I think I saw some analysis saying this would cost the tech industry alone, the mega caps, $14 billion, which on the surface doesn't seem like that much. But you look into the balance sheet, that's a lot of money to spend just on visa applications, let alone training. Yeah,
you wouldn't have seen this coming at the state banquet when you had Trump with all of the tech titans around him, everything looking cosy. You nod to the UK. This is an opportunity for the UK and the rest of Europe. And Kriti, you were flagging to us before we came on, the FT talking about maybe the UK administration looking to knock the fee for global talent visas here. But that's actually something that's been in the pipeline way before Trump did this. So this is an opportunity to get that top-level talent in.
It is. It's also another wrinkle for the labour market, a labour market that's becoming increasingly hard to navigate and understand. What happens in terms of the immigration story? Now, these are high-end. This is the high end of the labour market. These are super smart people that are being brought in to do very specific roles.
That's the whole point.
That's the whole point of this. But nevertheless, it's just another thing that's going to confuse the labour market at a time when I think the Fed is struggling to understand it, economists are struggling to understand it. You've got immigration, you've got changes in demographics, now you've got changes in visas as well. All of this just adding to the uncertainty around what the labour market looks like going forward. And this is what the Fed is hanging its hat on at the moment, and by extension, therefore, the market's hanging its hat on.
Absolutely. We should mention, though, that the futures, when you look at NASDAQ futures, you would think there'd be more of an effect. They're flat at the moment. Is this a read that maybe this is too far down to see the implications, or simply that maybe some of these tech companies can absorb the costs?
After the recent rally, a flat session feels like a kind of
win.
It just feels like a kind of giant thud to me after all the stock market rallies that we've seen of late across the board in the United States. Maybe it'll take a little time to digest the details, because the details have taken a long time to come out on this. Consternation over the weekend. Can I fly into the States? Can I not fly into the States? What's happening? Do I need to stay here? There's been some clarity, but I still think it's going to take a while for all this to, like the terror story, to percolate into the market. Let's talk about TikTok. Again, I don't understand what is happening here. So you had this you had this Trump interview that was recorded Friday for Sunday that talked about the Murdoch's involvement in the TikTok deal. And Trump talks about it quite extensively. And then the next day you get the details coming from the White House which don't include them. They include lots of others, but not the Murdoch. So I still don't think we have the details. There's also this conversation around the fact that the US is going to control the algorithm. But again, that looks from the Chinese side to be unclear too. So a deal we thought was kind of getting very close to completion and a roster of investors getting close to completion. I still think this Monday morning we don't know what's happening here. And I think it's going to take a little while again for the details to percolate and seep into the market.
Well, there's the fact that the potential framework of the deal includes 11 board seats given to Americans. Is that a TikTok-specific story, or does this set a precedent for any international company, Chinese specifically, that's doing business in the United States? And I think that's a conversation we're going to have potentially with Cathie Wood later, who, of course, has a lot of exposure to Chinese firms that do plenty of business in the States.
And more broadly, on the lack of clarity around this deal, if you zoom out and think about the US-China relationship post that Trump-Xi call, you've got Trump touting that they're going to meet at APEC in South Korea at the end of next month, but also talking about him going out to China next year, and Xi saying, or his administration saying, he'll go at the appropriate time. Do you think that that visit ever will materialise?
Well, the other piece of this in the readout, to your point, is that although they both talked about it, the one piece that showed up in the Chinese readout that didn't show up in the American readout was the fact that the Chinese said, can the Americans not undermine and unilaterally, while trade negotiations are happening, impose new business ideals? And I thought that was really interesting because you can see that the Chinese are clearly frustrated with that changing dynamic.
You just come back from D.C. Is there a different story within the Beltway on this and a different take on this than the rest of us are seeing? Is there something specific that's happening in D.C. that is adding to the confusion here? Just give me a sort of sense of what the readout is there, and is it different to what we're seeing in the rest of the world?
There is a bipartisan understanding in Washington that the Chinese need to be addressed and dealt with in some way, whether that's tariffs, whether that's on the geopolitical front. The images coming out of the Shanghai Cooperation Organization between Putin and Modi and Xi really sent chills, I would say even more so in the D.C. community than ever before. There's a massive defense conversation now happening in the South China Sea as well, and it feels like the narrative that's different in China, which I actually thought, or sorry, in Washington, that I think is different than London, is actually magnified in Washington more so than it is in London. I would have said maybe a month ago that the dynamic would have been the inverse, and there is not. The de-dollarization conversation, also enormous.
That's interesting. Is there a sense that Trump is losing in terms of his impact on the world? You bring up those images, Modi, Xi, Putin. Those are three major leaders getting together in a way that few would have predicted a year ago.
Yeah.
And that conversation strikes me as being something that would have, as you say, caused shockwaves. But is there a sense that Trump has caused this, that he has precipitated this, and as a result of which maybe the policy that is designed by the White House isn't delivering?
That is absolutely the concern and the criticism of it. However, it also has galvanized his base, and I would argue the Democrats as well, in terms of investing in defense spending, which is probably not what the expectation was going into this. But it's shown and almost validated a lot of what Donald Trump's rhetoric towards some of these giants, that in order to tackle them, you have to be tough on the world. You have to deal in the stick instead of a carrot.
Well, I would love to get the Washington perspective on what's happening with Palestine, because over the weekend you had Mark Carney of Canada, Keir Starmer of Britain, of course, recognising formally the Palestinian state, and we're expecting more to come. Denmark this morning saying it plans to follow. Australia and others going to follow at the UN General Assembly meetings happening in New York this week. And behind the scenes, you've got diplomats scurrying to limit the fallout with the US. But, Kriti, I do wonder whether there's a sense that Trump is losing is on the wrong side of history here in Washington.
Not really, which is surprising to your point because of how much of a global consensus there is around the world. And that fact is actually, I think, maybe bolstered the fact, at least domestically, the thinking that the United States needs to support Israel and really digging into their heels of not supporting Palestine. The concern, though, is what the ramifications are, the second, third derivative. Specifically in Washington, a lot of the concern is not necessarily on the recognition of Palestine, but does this all galvanize the Emiratis, the Saudis? Is there some sort of fallout from Iran we're waiting for? And that seems to be more the consensus in Washington.
But we had this brilliant piece over the weekend about the future of the Abraham Accords, Trump's signature foreign policy achievement, right? And pointing out that it's Saudi Arabia that's put Palestinian statehood at the heart of keeping up this normalisation of relations with Israel. So surely that's the flip side of the argument that the US needs to be the main defender of Israel.
I don't know how I don't know how this is going to play out, and I don't know whether the bit that I can't figure out is what the effect of this is. Okay, so let's put all the kind of the geopolitics and the politics kind of to one side. Does this change anything materially in terms of the way that the Gulf functions, relations with the Gulf function, how the economies in the region function as well. Israel's looking increasingly isolated. How does that change the dynamic within the region in terms of its economic impact? That's the bit that I don't know yet, but it feels like we're inching towards something that feels quite different to where we were even 6 months ago, 18 months ago. And I don't know what the effect of that is yet to be. You take Israel, the Israeli economy, out of the region, kind of isolate it, ring-fence it. What changes? How does it affect regional economies? How does it change the Eastern Mediterranean? I'm just trying to look at, from a sort of Bloomberg point of view, I don't know how to treat this story yet.
Well, I think if you go back to the Qatar attack, the Doha attack, that was the game changer, geopolitically, but also callously in the business sense, when it comes to the risk premium that it takes to be based in the Gulf more broadly. OK. Let's move on and talk about some of the stories that we're going to be watching throughout the rest of the show and some of the guests we've got lined up to talk about it. Chris Watling, Longview Economics CEO, is going to be joining us shortly. His take on what is happening with this stock market rally. Michael Roberts, HSBC's CEO of Corporate and Institutional Banking. It is 1 year since we saw the changes start. El Haredi coming in at HSBC. Stocks up 55%. What happens next? Tough work still to do. Sharon Bell, Goldman Sachs, Senior European Equity Strategist, joining us. Where do European stocks go? Where does the tech trade go? We've got a perfect person to answer that question. Cathie Wood, ARK Invest CEO, joining us a little later on the show, Lizzie. Looking forward to that conversation. Here's what we've got on the docket for the rest of the week, though. Today, we're hearing from the Bank of England's Governor, Andrew Bailey, speaking at a fireside chat at the London School of Economics. He had said he wasn't worried about the moves at the long end of the gilt curve. We saw some big ones on Friday, so I wonder what he has to say about that. Then tomorrow, we've got the global flash PMIs, another read on the impact of tariffs, the Riksbank decision as well. Then on Wednesday, we have the German IFO numbers for September, Thursday's SNB rate decision, and Friday, the big one, US PCE. Of course, the Fed's preferred inflation gauge expected to have ticked down from 0.3% to 0.2%. So a little more room to focus on the labour market, if that's the way it comes out.
Powell speaks tomorrow. Looking forward to that. Looking forward to what he has to say. Is there a change? I can't believe there's going to be a change in tone since we saw the decision coming through, but maybe a few details around that decision-making process at the Fed and the Miron effect in all of that. Miron,
yes, the Miron effect. Also, who's going to be in the room at the next meeting? Well, I mean, that play out in terms of Lisa Cook is still going on. Stephen Miron, of course, the lone wolf right now in terms of the cuts. But do you start to get other people on his side? We'll see. OK, let's turn our attention to what else is happening in the world. President Trump has described Charlie Kirk as a martyr for American freedom. He was speaking at a memorial service for the conservative activist who was shot dead at an event in Utah earlier this month. Kirk's widow, Erica, also spoke, saying she forgives her husband's killer, an approach the US president doesn't share.
He did not hate his opponents. He wanted the best for them. That's where I disagreed with Charlie. I hate my opponent, and I don't want the best for them. I'm sorry.
Turning to other news, Hong Kong Airport is set to significantly reduce flights from 6 p.m. local time Tuesday as a super typhoon approaches the region. Hundreds of flights are expected to be cancelled. Super typhoon Ragasa is currently passing the northern Philippines. Wind speeds are up to 230 kilometres an hour. It's forecast to be closest to Hong Kong on Wednesday morning. Authorities are warning of a, quote, serious threat. And the UK government has given the go-ahead for a second runway to be built at London's Gatwick Airport. The £2.2 billion project, Britain's second biggest airport, will be privately financed. Gatwick says it will add capacity for an extra 80 million passengers a year. They've actually got two runways at Gatwick. They just need to kind of move the temporary one. The backup one, I think it's 10 metres to the north to make it actually so you can run two runways side by side. The other thing as well is we're still dealing with this hack from this weekend. It looks like we've still got outages being caught. I think Brussels is still having problems. Yeah. So, again, plenty of travel news this morning. If you want to go to Hong Kong, maybe pay attention to what is happening with the weather. If you want to go to Brussels, maybe pay attention to what is happening with the cyber story.
Go, stay put.
Yes.
We'll see how that's all interpreted at the market open for a sector to watch. Coming up, also another sector to watch, certainly in the banking story. BBVA raising its bid to buy rival Sabadell, potentially reviving the Spanish banking consolidation deal. Plus, of course, geopolitics is firmly in focus. Estonia asking the UN Security Council to discuss Russia's violation of its airspace. We'll dive into the latest developments. But up next, we go right back into the markets. Our next guest is going to talk about how we interpret all of this and how you actually fold it into your market view. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
We have to study constantly this interaction between the labor market and inflation. But that doesn't mean we're immune to the changes that AI could be creating in the labor market.
San Francisco Fed President Mary Daly speaking there. Lots to digest in these markets. Bloomberg's Valerie Titel is here to break it all down. Val.
And lots to understand about how these tighter immigration policies are going to affect the U.S. economy. It's notable, though, that it's not very much denting the rally in tech stocks. NASDAQ 100 closed at a record high on Friday. We're only down less than 0.2% off the back of this H-1B news. And the connection here is that the Mag 7s are very heavy users of these H-1B visas. Amazon is the top user. You also have Microsoft, Meta, and Apple on that list. But it doesn't seem to be taking any heat out of this tech rally at the moment, just down less than 0.2%. Perhaps the bigger question is, what does this mean for U.S. economic growth? And perhaps we'll hear from Jerome Powell on this topic on Tuesday. He will be speaking about the economic outlook, and with a Q&A on deck, he will be likely asked about immigration policies, tighter immigration policies. Does that worry him about a negative impact on growth, or could this be something that could tighten the labor market in the near term? It is notable that last week at the press conference, he did mention that college graduates are having a hard time finding jobs. We've seen that reflected in the long-term unemployment rate. These are the unemployed for over 27 weeks. It's now at nearly 26% of the total unemployed. That's a high we've not seen going back to 10 years. The other argument, though, could be that he is seeing this as a negative for U.S. economic growth. And this ties in what we heard from the new Fed Governor Miron on Friday. Speaking to CNBC, he again reiterated his view that these immigration policies coming from the Trump administration are disinflationary in nature. Guy?
Valerie, thank you very much indeed. Looking forward to hearing what Powell has to say on all of this. It's always new news for him to have to digest. What do we make of the rally, though? Doesn't seem to be dented by the visa news this morning, certainly when it comes to the tech story. Are we seeing a broadening out? Do you continue to chase a market which I'm hearing many professionals aren't exactly fans of? Chris Watling, CEO, Chief Market Strategist at Longview Economics, joining us around the table. What do you think of this market right now? Do you love it or you hate it?
Well, there are parts of it that are very interesting around the world, but the main part everyone focuses on, I think, is, it's getting pretty frothy. It's frothy short term, and it's got expensive valuations when you're thinking medium term. And the US economy, there's kind of an assumption that it's all kind of okay, but actually there's some real concerns out there about the US. It's quite a mixed picture. It's very dichotomized, if you like.
So what do I do here? Do I sell the kind of the bit that everybody's chasing, the FOMO part? Do I get into other markets around the world? Am I looking at Europe? Am I looking at China? Am I looking at small cap, mid cap? Kind of, if I don't like the bit that everybody's obsessed with at the moment, do I like other bits?
Well, I think, what you want to do is you want to look for alternative earning streams that are emerging in the world.
OK, which are? Give me examples.
Well, I think we're in a global rate cutting cycle.
Yep.
Yeah, so they tend to deliver earnings growth. And there are examples already, and there will be more, I think, over the next 12 months. But, I mean, Spain's had terrific earnings growth over the last 12, 18, 24, 36 months, better than the S&P. There are other examples. Italy's had good earnings growth. And you can find these markets. Now, the problem is they're not big enough for most people, and the S&P's so dominant. I think the way to play it really depends on your time frame, but I'd be very cautious near term. I think this market needs a bit of a flush.
Just before, how cautious? A flush, what does that look like?
A flush, maybe 5 to 10% on the S&P.
Okay.
Maybe a little bit worse, but that sort of magnitude. There is a lot of liquidity around, so how much of a flush is the debate. But beyond that, I think the world's cutting rates, so earnings streams are coming. We're going to broaden this global rally out to the rest of the world, and could be US small and mid cap, could be parts of Europe, could be all sorts of places.
So what's going to trigger that correction, Chris?
What's going to trigger? One never knows. But when things are frothy, I mean, people always ask that question, and one can come up with a whole list. I mean, it could be all sorts of things. But just look at US corporate spreads, bond yield spreads. They're so tight. They're sort of at record 34-year, 40-year tight levels. So, it's like everyone's all in. And when everyone's all in, it doesn't take much to topple the apple cart.
And isn't it strange that you've got gold up as well as stocks? Do you buy gold? How much gold should you have in your portfolio?
I think gold's nearing the end of its bull run that's been going on since the end of 2022. So it's had a terrific run since October 2022. And I think we're in the last gasp of that. The Elliott guys would call it the fifth wave, the sort of blow off top. So we've been, in the last few months, we've been starting to dial down gold. And you can feel that people are starting to love it. And that's a good sign we're getting near the top.
I want to bring you right back to the equity market. You say it's looking frothy. By what metric?
We measure risk appetite. So when you get a sort of, you get excessive in enduring risk appetite, the market's become greedy. It's become very, very greedy. We measure it on a daily basis from across the globe in lots of different ways. And the models are pretty clear. It's certainly there. And it's confirmed by, like we said, on high-yield corporate bond spreads are very tight. So, there's quite a lot of markets around the world. When you get a signal on our sell-off indicator, you see certain equity markets go vertical.
Yeah.
So you could look at South Africa, Chile, I forget which ones. Look at, there's quite a few of them. They've sort of gone north. And when they go north, everyone's being squeezed in and shorts are being squeezed out. And it tells you you're getting near the top of this run. So markets are very emotional short term, as Benjamin Graham tells us. Or did tell us back in the day.
What a reference. Unlike the bucket shops of that era, when you're talking about shorts getting squeezed out, it's not happening in the S&P 500 too. It feels like it's very expensive right now to be bearish.
Yeah, it is expensive to be bearish. So you don't want to be aggressively bearish. You don't want to push your luck. But I think
you're calling for a technical correction.
We're calling for a technical correction. When we're looking medium term, we are now neutral US large cap. We're going overweight other stuff. And the debate in our mind is, do you go underweight US large cap and overweight other stuff, but be overweight global equities? That's the really debate. So, and the pullback in the short term gives you the opportunity to take that decision.
So the mentality of late, well, for quite a long time, has been buy a dip. You see, this is an opportunity. Is it an opportunity? Is the long term? You talk about medium term, things are still quite frothy. Do I buy a dip if medium term
Well,
if
US
the situation
large cap is expensive. Everything else is cheap.
Right.
If you look at the PE ratio gap, I'll just take a median PE ratio of the US and Eurozone.
Yep.
It's been widening for 8 years.
Yep.
5 years ago it had never been wider. It's even wider now. So there's lots of that cheap stuff around the world.
But if the S&P drops, generally it has a gravitational effect.
Yes.
Everything else drops as well.
Yeah. Yes, initially.
Yep.
But then the recovery can be different.
So if a dip comes, where do I buy first?
Non-US large cap.
Okay.
And it's equities that cracks first.
It all go in terms of the pullback. The short-term pullback is risk assets, risk off, basically. I suspect gold might get caught up in that as well. But generally, risk asset, risk off, near term. Use that as an opportunity is our thinking.
All right, you've had your warning from Chris Watling, CEO and Chief Market Strategist at Longview Economics. It's always good to have you around the table in the morning, Chris, especially on a Monday. Thanks so much for joining us. And I do recommend a look at Chris's Twitter, which was...
Oh, yes, we hooked up on Twitter, so to speak. That sounds totally inappropriate. But yes.
Fab memes, I have to say, from Chris Watling. But coming up on the programme, we're going to be joined by Michael Roberts, Chief Executive of HSBC Bank and CEO of Corporate and Institutional Banking. Plenty to discuss. We're going to get an update on the lender's restructure and get his take on the outlook for the banking sector more broadly. We're nearly a year into the takeover from George Elderhary, so plenty to discuss.
30 minutes away from the start of the opening trade. There's a lot of news to digest. Does it show up in the futures picture, though? Is it tradable? Ultimately, when you look at the futures picture over in the States, seeing a little bit of weakness, seeing about the same margin of weakness and the European side as well. Your stock's 50 futures down about 0.2%, we'll call it. The underperformers, the FTSE 100, but again, not by much, Lizzy.
Let's check in on your bond space as well, shall we? Of course, we had on Friday Fitch upgrading Italy a week after it downgraded France. And here we have the German two-year yield there at 2.75. Really not a lot of movement here. I was watching out for the UK when we get it because, of course, we had huge moves on Friday. We'll keep an eye on the gilt space as well.
OK, let's turn our attention back to the corporate news and figure out what is happening there. It's been a year since George El-Hedry took over as the CEO of HSBC. The stock is up sharply. I think it's trading at a 52-week high, kind of near there. We're up circa 55% on that year. And HSBC, during this period, has changed a great deal. We've had a major overhaul. There are now 4 new divisions with a focus very much on wealth. Expenses, though, have also risen sharply, and the bank is still dealing with the property slump that's taking place, as we all know, in Hong Kong and China. Let's get an update on where we go from here. Michael Roberts is the Chief Executive of HSBC Bank and the CEO of Corporate and Institutional Banking. Good morning, Michael.
Good morning. Great to be here.
Is the easy stuff done? The stock's had a great run. You've reorganised the business into 4 divisions. The market broadly has been on board so far. But does the tough bit now come? You've got to deal with the expenses. You've got to figure out exactly what the wealth division and how it's going to function to become this kind of global leader.
Yeah, no, it's a great question. A lot has been done. In fact, I think we're very proud about the speed, about the scope of what we've been able to achieve in really a very short time. It's been less than a year, and I think no one would argue that we probably have done more transformation, more change at HSBC, potentially in its history. And so we're very, very proud of what we've achieved. I would love to say the easy things have always been done. There's always tougher things to do, in particular in an ever-changing environment. But we have done it quite a lot, in particular around the organizational aspects of the change.
So what does year 2 bring?
Year 2, I think, in particular for my business, brings much more focus on simplification, much more focus on really just efficiencies, and that by meaning not just cost efficiencies, but just being a better bank, being able to respond quicker, to be more agile. All the things that really takes a long time.
Do you think some of that's already in the price, in terms of the share price performance thus far?
I don't know. I mean, I think a lot of it is certainly in there. I think you mentioned the cost. You know, as George has said many times, we will achieve the cost savings that we have set out to achieve. We're very confident as a management team we'll do that, and so that's fully in train right now. But clearly, you know, we have to respond to the environment. Clearly, we have to respond to all of the policy changes that are coming out from various places. So, yes, I think we have done a lot. I think we will do more to do. I think it will be focused on really making the bank just a better bank, operating more efficiently. I think probably the stock market understands it. In fact, it's a 22-year high is what it is. So it's an extraordinary, I think, positive response from the market. But we clearly will always have more to do.
HSBC has exited a series of businesses lately to focus in on that kind of restructuring that you've just outlined and the cost efficiencies. As the youth would say, there might be a little bit of FOMO there. Do you think you're missing out on this big moment for Europe, this big moment for the UK, as people look to diversify away from the States?
No, and I think you're referring to what the investment bank, the changes there, because we have actually had a lot more disposals of various types. Not really, no. And I think the reason being is that we were never a bulge bracket investment bank. And that is something to everybody understand. We were a good investment bank, in particular where we have scale and relevance, Asia and the Middle East being those regions. And if you look at how we really perform and what our value added, it is really the cross-border nature of our business, and it is really in regions which we have an undeniable leadership position, Asia and the Middle East being those 2 regions. And thirdly, those are the regions for the future. Those are the regions that will grow. Think about 10 years from now, it's not going to be the same. And, you know, I grew up in investment banking. I understand exactly what everybody's talking about. 60% of the fees are in the United States. And we are in the United States in our debt business, by the way. We've just reduced our M&A and equity business there. So we can still utilize the value of the capital markets, which are the largest capital markets in the world. Obviously, very important to be there. So we have a lot of deals that go to the U.S. capital markets. That's great. But the future is really Asia and the Middle East.
So critics of that argument would suggest that the experience of 5 years ago during COVID, when Asian markets were largely closed, and a lot of the investors that were very bullish on Asia kind of learned their lesson and really pulled out from that kind of exposure. It's taken a while to even dip a toe back in. Why, not necessarily in COVID, but in another circumstance, should people increase their exposure to a region that has historically not always been the most sure bet?
because I think that's an enormous amount of wealth creation occurring right now in Asia, whether it be India or China. I think Hong Kong will become even a more important capital markets or center for capital markets around the world. I think that you see a huge amount of capital and trade flows going between the Middle East and Asia. You have two regions that have an enormous amount of capital, and they're exchanging capital back and forth.
But is any of it coming from the States or from Europe into
Much less.
Asia?
Well, still there will always be. Yeah, I mean, if you look at where American companies are expanding, they're expanding in those two regions. If you look at where European companies are expanding, they're not expanding in Europe. I think the U.S. is largely done. They're expanding in those two regions. The interesting thing, however, is the amount of money going from the Middle East into Asia and vice versa. I think we have underestimated that is a significant and I think permanent trend, and that's where we're there is to capture those flows as you have a reordering of the world's capital flows.
Michael, I want to talk about staffing. You talked about some of the headwinds floating around the world. Diplomatically put, many of them come from the White House. We've had this change on the H-1B visa. How much does that affect you? Because we know it affects tech heavily. It also affects finance.
It does. You know, our operations in the United States are about 6,000 people, so relatively it's much less than if you're Microsoft or Google or some of the big tech companies or some of our American competitors. We had a flurry of activity this weekend, like everyone else. I think it was unfortunate because the initial policy was unclear as to whether it was retroactive or prospective. They've now clarified that it is prospective, so that makes it much easier. I think it was going to be very disconcerting for a lot of people, in particular those holders of those visas who were traveling abroad.
But are you instructing staff to stay put? Do you think in the longer term you'll have more staff based, say, in Asia or in Europe?
You know, again, we don't have a huge amount of the H-1B visa holders. Yes, I think for all companies, you know, to pay an extra $100,000 on top of everything else, it is going to change the way we look at staffing. I think for us, it's manageable. I think for maybe other financial services companies similarly. I think for tech companies, that is a much bigger issue.
Can I just come back to this question of the relationship between the Middle East and Asia and the changing kind of nature of global trade? Kriti's just spent 3 weeks in D.C., talks about de-dollarization, this kind of process that is unfolding, this concern that there exists in the United States about that. Do you think that relationship is enduring? Do you think it's been created to a certain extent by the Trump administration? Are we seeing a reordering in the sort of tectonic plates of the world as a result of what is happening out of D.C. and forcing other people together? Yeah,
look, it's a very good question. The answer is I don't know, because I think the policy changes quite a lot. I think clearly if you're not going to have the dollar as the reserve currency, that forces a major reordering of the world's economic structure as we know it today. I think there is concern. I've talked to many investors, those in Asia and elsewhere, who are quite concerned as to what this means. There is no alternative. And that is the reality. There will not be an alternative for many, many years. And so tomorrow, if the U.S. dollar is not the reserve currency, what is? It's not the renminbi. It's not the euro. I mean, the actual relative change between currencies, reserve currencies, has not changed for the last 20 or 30 years. In order to have a significant change, I think it takes a long time to do. So if, however, there is a major policy change, there is, for instance, you know, some discussion of taxing foreign holders of U.S. Treasuries, as an example, that would send a signal that, yes, I think you'll have a evolutionary change, just because of practical reality, you can't do it quickly. But that would introduce a significant amount of uncertainty in the world's economic order.
You talk about Asia and the Middle East becoming, to follow on Guy's question, this kind of new sphere of growth. Can it still hold the level of innovation, financial innovation, that you still see from the States? I'll give you an example. In the private markets, for example, yes, they're expanding, but the driver of that financial market innovation, things like democratizing 401ks in terms of getting access to private markets, in terms of the IPOs, in terms of some of the structured products that are out there, it's still driven by the large-scale American players. Are you still seeing some of that innovation be done more organically from the Middle East or Asia, or is this about adopting what starts in the States?
Yeah, look, I think clearly, from a financial perspective, the U.S. capital market is still the dominant capital markets. A lot of the financial innovation comes from the U.S., having been there for most of my career. So very well aware of that. However, I think you'll see, a very quick adoption of many of those type of changes into both the Middle East and in particular in Asia. I think it's not only, by the way, financial innovation. I think it's also industrial innovation, technology, which is coming out of places like China fast and furious. I mean, I was also in Silicon Valley the week before last. I was in Israel last week. I will go to China, and just to see all of that innovation is pretty extraordinary that's going on, and it's just not American innovation anymore. So I think that's one thing everyone should understand. Financially, yes, you certainly benefit in the United States by having the largest, most liquid financial markets, and you have some of the largest banks in the world, so that's very helpful as well. But I don't think that will be confined to the U.S., and I think more and more you'll see U.S. players focusing on places like Asia. We see a huge amount of that, the inflow of U.S. capital into Asia. They will bring technology with their capital as well.
What's HSBC doing in the private markets? Are you growing as fast as maybe some of your peers
in
the
the
States?
Yeah, and
what does that look like?
Part of our restructuring is to put all of our private credit activities in one place. It was not in one place before, so we're doing that as we speak, and that gets to your question about what are the things we're going to be doing going forward. Yep. It's what I call debottlenecking a lot of those issues. Every bank has this as a problem, by the way, is how do you respond to private credit, which is a new type of financing, which doesn't really necessarily fit with the conventional way banks have been structured.
Is there systemic risk in private credit?
We looked at it very closely. In fact, we've had lots of discussion internally and even with our board. There will clearly be always systemic risk. The question is how much leverage there is. What would be the trigger for that systemic risk is something that we look at very quickly, or very closely.
Michael, Guy started by asking you about the restructuring. We're a year in.
I figured he would.
How's morale?
Look, morale's fine. I mean, and no one likes to go through restructuring. And the reason we've moved as quickly as we have, which I must say again is as quick as we could possibly do it, is very, very sensitive to morale issues, very sensitive to being distracted. That is very distracting. I think we're in a position now to say that first phase, that organizational change phase, is coming to an end. And that's probably the most important thing. Not that we don't have more to do, as Guy asked before. We will continue to, I think, improve the place, make it easier for our bankers and our traders and our salespeople. That's what we're going to focus on going forward. That's rewiring and replumbing. That, by its very nature, is not quick. And I just told a group the other day, bear with us. We know what we're doing, but it will take a while. But we're doing, I think, some very interesting things around AI, doing very interesting digitization that will make their jobs easier, but also plays through right to the clients. That is really where we see a lot of value going forward.
Okay. Michael, thank you so much for making time for us this morning.
Thank you very much. Good to see you all.
Lovely to have you. Michael Roberts, Chief Executive of HSBC Bank and CEO of Corporate and Institutional Banking.
In the meantime, I want to stick with the banking. Just issue a correction from some news that we reported earlier, I believe an earlier hour of Bloomberg Television. We were covering the revised deal out of BBVA. I just want to correct. We had said previously that the new deal contained a cash portion as the original offer. I should mention it's actually an all-stock transaction. We're going to keep an eye on that deal and see how it shows up at the opening trade, Guy.
OK, what have we got coming up? We're going to keep an eye on the auto sector as well. There's kind of news out of Friday that's going to impact Monday. Porsche shares, VW shares, likely to take a little bit of a hit. We've seen VW trimming its guidance. Basically, they feel they made a mistake by going too far down the EV route when it comes to their high-end vehicles. They're backing away from that. There is going to be a cost associated with that. That is going to impact the full year and therefore likely to be priced in first thing this morning. I'm seeing the stock down a little bit, actually a little bit. 4.5%, 5% on VW. Well, we'll get the details in just a moment. That's next. This is Bloomberg.
The UN Security Council will meet today at Estonia's request to discuss a violation of the country's airspace by Russian fighter jets last week. Estonia's foreign ministry termed Russia's actions part of broader Russian campaign to test the resolve of Europe and NATO. Bloomberg's Oliver Crook joins us now from Berlin. Ollie, just talk us through what kind of UN reaction we can expect because of this Russian incursion.
Yeah, let me just get the sort of facts straight on what happened on Friday exactly, because it was a 3 armed MiG-31 fighter jets, Russian ones, according to the Estonians, that violated Estonian airspace for a total of 12 minutes, marking the 4th incursion on Estonian airspace, they say, this year. And some of the reaction has been, of course, the meeting of this UN Security Council that will be happening at 10 a.m. Eastern Time a little bit later. But what it also provoked from the Estonians is triggering Article 4 of the NATO Charter, basically saying that whenever your territory is threatened in a substantial way, you have consultation with other NATO allies. That is the 9th time that has been triggered over the last few years, or I should say the last 80 years or so, since 1949. And the last time it was triggered was 12 days ago when the Polish airspace was imposed upon by those Russian drones, some of which made it up to 300 kilometers within Poland. So the action then goes to New York City. Of course, it is also the UN General Assembly this week, where you have world leaders assembled there to discuss on global issues. Of course, Russia and Ukraine will be a central part of that discussion, maybe not as central as it has been over the last few years. But the question really ultimately is, how is NATO going to respond? This is seen largely by the NATO allies as a provocation from the Russians, and of course waiting for Donald Trump's reaction. We've heard from Donald Trump speaking on this event a couple of times over the last few days. The last he said about it yesterday was saying that he didn't much like what he had seen so far. The Russians, for their part, saying that they did not violate any airspace, and this was a sort of routine flight from the northern part of Russia over the Baltic to Kaliningrad. So that's sort of where the state of play is as we await that meeting a little bit later today at 10 a.m. Eastern Time in New York City of the UN Security Council.
Ollie, thanks very much indeed. Oliver Kirk joining us from Berlin. He'll be back later. We'll continue to update you on all of these stories. It's going to be an interesting week, certainly from a geopolitical point of view, with UNGA taking place in New York. Plenty to focus on there. Let's return now, though, to the markets and figure out what is happening there. We're joined by Bloomberg cross-asset strategist Ven Ram. Ven, we've got an awful lot on the docket this week. We've got some data. We've also got an awful lot of Fed speak. We're watching what is happening in Japan. What's top of mind for you? What are you thinking about as we start this fresh week?
Morning, Guy. I'm thinking about the implications of the LDP leadership race for the global rates market. As you know, there are a handful of contestants for the LDP leadership race, but 2 of them stand out. One of them is Shinjiro Koizumi, the former Prime Minister's son, and Sanae Takaichi. Now, Koizumi is conservative, fiscally conservative, but Takaichi is more inclined towards fiscal stimulus. She is all for easy monetary policy. And we have already seen that Takaichi is earning kind of notoriety as Japan's Liz Truss. So these are early days yet, but if Takaichi wins, there will be implications for BOJ and rates globally. There is a threat that the BOJ could fall even more behind the curve, and then that is not good for JGB yields, that those will spiral higher. If there is any suggestion that the finance ministry is going to prevail upon the Bank of Japan not to raise rates anymore. So I think that it's got global implications. We've already seen that ripple through. I mean, we've got this story globally of, yield spiraling, whether it is the US, France, or even in Germany, where, fiscal rectitude is never an issue, and obviously in the UK as well.
Well, then, staying with yields, on Friday you had Fitch upgrading Italy. Happy news for Maloney, but it's a week after Fitch cut France. I wonder how you think this is going to show up in the markets. You say BTPs could be outperforming Greek bonds very shortly.
Absolutely. I think that there is room for Italian bonds to outperform Greek bonds for the simple reason that because of Fitch's rating upgrade, Italy is now BBB plus. And Greek bonds are rated BBB-. That's 2 notches lower. But if you look at the secondary market for bonds, Greek yields are actually trading lower than Italian yields, and that can't be that spread can't be negative, even though given that the ratings is definitely in favor of Italy. And therefore, I expect that the spread to close out in the coming months as bond investors warm up to Italy. Now, Italy, we've got to remember, has gone from the poster child for being fiscally profligate to one of fiscal rectitude. And, now next year, Fitch expects Italy's deficit to go below 3%. Now, the EU's deficit procedure, excessive deficit procedure, applies only when your deficit is above 3%. So they're going to 2.7%. So who knows? They may even win another rating upgrade down the line. And we've certainly got Moody's and S&P reviewing Italy's rating again in a couple of months. So we'll see where that takes us.
All right, Bloomberg cross-asset strategist Ben Ram watching the bond market for us very closely. We thank you so much. Let's go from the bond market to the stock market. Chloe Melly has that for us. Chloe.
Good morning, Kriti. Let's start by keeping an eye on Porsche and parent company Volkswagen today. That is after Porsche decided to pull back on its electric vehicle strategy, which led it to slash its outlook for 2025. Porsche is currently course-correcting because of really low demand for luxury electric cars, and it's now moving back into that combustion engine models. This is also the fourth time that Porsche has cut guidance this year, and this is likely to put even further pressure on the shares, which have been, we see now here, down 47% over the last 3 years. There was obviously the listing happened in 2022, and it's been on a steady decline, dealing with lower EV demand, China slowdown, and also tariffs, of course. Moving on to the telecoms sector, where we could see some movement in the shares of Nokia and Ericsson today after Vodafone 3 decided to award a £2 billion contract to expand its UK network to those two companies. Those two companies have been moving in tandem over the last few months and could need a little bit of a boost. Moving on to Generally could see a little bit of weakness today after its asset management tie-up with BPCE is looking increasingly under strain. The plan is to create Europe's second largest asset manager, but Mediobanca, one of the largest shareholders in Generally and also one of the biggest backers of the deal, is obviously being taken over by Monte Paschi. So this is creating a little bit of uncertainty, and that means that this deal could potentially be drifting a little bit closer towards a collapse, potentially.
All right, Chloe Melly, we thank you so much. With our stocks to watch as we approach the open, we're looking at futures pointing lower here in Europe ever so slightly. We're looking at stocks 50 futures currently down 0.2%. We'll bring you the opening trade next. This is Bloomberg.
Welcome back Monday morning. Let's talk about Friday, though, just to give you a kind of setup into what we are watching as we start this new week. European equities actually faded towards the close on Friday, but then US equities took off, which is interesting. We closed out down here. We got this rally late in the day stateside. What is interesting on the back of this is the fact that actually, Kriti, we've got a not particularly positive picture emerging from futures this morning. So despite the fact we've actually got a little bit of a kind of gapped price to the upside, we're not seeing that necessarily being replicated in the futures picture here in Europe.
I think this is what we call a breather, maybe a little bit of a siesta here in Europe, at least when you look at the downside. Only down by 0.2% though on your stock 50 futures. So, Guy, I wonder if maybe at the open we see a little bit of that retracement, maybe a little of that momentum you saw showed up on the chart, the catch-up showing up after a little bit more liquidity hits the market. That being said, the underperformer has gone from the FTSE 100 to the DAX. Those futures, Lizzy, down about 0.3%.
Yeah, let me take you to the car space. We have Porsche and VW lowering their forecast because of the pullback from electric vehicles. So do keep an eye on the expected drop in Porsche shares at the open. We're also staying with transport, watching the airlines after this cyber attack causing these weekend delays. European shares could be really active here, the likes of IAG, EasyJet, Jet2, of course. Also noting, of course, the UK approving that second runway at London Gatwick Airport. So keeping a particular eye on the British Airways owner IAG. Just finally, to your banking space, BBVA boosting its offer for Sabadell with this €17 billion all-share bid. We mind the European banking space as well.
OK, here we go. Time for the market open this Monday morning. Got a lot to factor in. There's also a lot of geopolitics that need to be rolled into these markets as well. But it's going to be the auto sector, I think, is going to be interesting. Keep an eye on tech to see what happens there. Banks as well, maybe. Right, here we go. Let's talk about what we are seeing this morning. You're going to see some banking stories emerging. You've certainly got the Spanish story to factor into your thinking this morning. It was interesting to hear what HSBC had to say just a moment ago. You've got the airlines that are going to be in focus as well with the travel delays, plus also what is going to be happening with VW. I wonder how long it takes to get the DAX open first thing this morning. The FTSE 100 out of the gate, flat as a pancake, nothing to see here. Similar sort of story over in Spain. We're down by 0.2%, where we're going to fold in that banking story. What's happening with BBVA? CAC 40's actually out reasonably early, nothing to see there. It does look as if the market's fading a little bit this morning. Keep an eye on the defence space there, though. So there's some interesting moves happening around Airbus and what is happening with Dassault on the next generation fighter story. That could be a factor for that market as well. We're going to wait, I suspect, a little while to get the DAX open first thing this morning. Too many stories in that market to get things going early. So we'll see what happens with that space. But at the moment, a cautious start for the European week, Lizzie.
Yeah, so we've got about three-quarters of sectors in negative territory at the open. Media at the bottom of the basket, down 0.5%. Leading the gains, basic resources up 0.75% at the moment. But I promised we'd check in on the airlines for you. And indeed, many of the big names in the red, the likes of IAG down 1.2%. Similar moves for Air France, KLM. EasyJet down 0.8%. Also minding the open for Volkswagen and Porsche, but we wait for that. And we mentioned the banks, Sabadell down 2.2%, BBVA 1.1% down. So misery there after boosting that offer in the latest on that M&A, Kriti.
Yeah, it's fascinating that you are seeing both the target and the acquirer trading lower. So we'll see how that shakes out. We're going to have our Madrid bureau chief join us shortly to walk us through that deal. The underperformer from a weightings perspective, though, Guy, happens to be tech at the end of the day. SAP, Schneider weighing down the index. ASML seems to be the only tech name in the green right now. So I think it's kind of a tale of two tech stories maybe this morning.
I wonder whether is tech trading on the Visa story this morning, do you think? Or is it something else?
Could be.
It feels like it's a negative, but in some ways you could argue, like companies like SAP employ a lot of people in the United States. This is going to be a cost for them. This is a global business that has a huge footprint there. The banking sector is being affected by this as well, as we were just hearing from HSBC. So I do wonder, is this just a cost story? There you go. We're going to see some effect going through into the United States. More of a software story than maybe a hardware story. That's maybe why you get a bid, maybe a rotation into ASML this morning. Not sure, but that would seem maybe a logical sort of explanation.
Should we ask an expert? Sharon Bell, Senior European Equity Strategist at Goldman Sachs, joins us around the table. Morning, Sharon.
Good morning.
Let's start there. Do you think that this Visa story is an opportunity for European tech?
It's interesting, isn't it? Because I do think it adds an extra layer of uncertainty. Again, cost uncertainty injected into the market, a new policy that was perhaps unexpected. So all of those things, I think, a little bit unhelpful on the cost front. But US tech has been growing very fast, hasn't it? So it may be able to absorb some of these extra costs as well. But yeah, I mean, there's some opportunity maybe for Europe.
And here in Europe, of course, we've been in pretty tight range for most of the year. Do you think that there's much further to climb before the year's out?
Yeah, we have been in a very tight range. I would say Europe did really well in the first quarter, and then since then it's been kind of flat, hasn't it? It's been trading in a range. I do think Europe can continue to make some progress this year, but I think it's going to be relatively modest. Even the European market, after the rally we had earlier this year, doesn't look all that cheap versus its own history.
Is anything cheap right now?
No, not really, I'm afraid. I mean, gold certainly isn't. It's rallied up very strongly, hasn't it? And the US equity market, obviously, in the 95th percentile of its range. Everything looks quite expensive. Probably the only cheap assets are the ones where, people really haven't liked them in the last year or so. Defensives, some of what we used to call the granolas, which are the kind of big caps in Europe, which have got global exposure, which just haven't done very well in the last year.
How much of the equity story right now hinges on the bond market story?
Yeah, I mean, the two are obviously hugely interlinked. If you saw a very rapid sell-off in bonds because perhaps people were worried about any sovereign risk in Europe, or maybe they were worried about inflation coming back, and that will prevent central banks from easing policy or keeping rates on hold, all of those things would be a danger to equity. Effectively, equity, because it is quite expensive, has a narrow path to tread, one where you don't fall off on the downside in terms of recession, and when you don't fall off on the other downside in terms of higher inflation or higher bond yields.
Let's talk a little bit about currencies. Can't speak this morning. I'm still down as a European investor in the S&P in euros.
Yeah, I mean, look, Europe hasn't done... I think if you look at the chart of the S&P, you think it's been thrilling, which it absolutely has been thrilling. If you're a dollar-based investor, it's done extremely well. But if you're a euro-based investor, or even any other global currency almost, because the dollar has weakened, for you, in your own local currency, the US market hasn't done so well.
Does that trend continue? European markets, despite the fact they've been flat kind of nominally, are they going to continue to outperform because the currency's going to do the lifting.
That is some of what we think. So for this next year, we look at the euro-dollar going to about 125. So I think we're about 118 at the moment.
Yep.
So it's quite a big further rise in the euro. And we think if you invest in the European market, you'll get a little bit of price return, and then you'll also get the euro going up versus the dollar as well. Largely because of dollar weakness rather than euro strength, in our view.
So if there was a dip globally now, say equity market sold off by 10%, and I was looking to buy the dip, where would I buy the dip? Where would be the best place to buy the dip? And would that depend on whether or not I'm a euro investor or a US investor?
Yeah, it's an interesting question. And it's an interesting question you pose buying the dip, because I think it's one of the reasons you're not getting a dip is because everyone wants to buy the dip as soon as you even discuss a dip. But yeah, look, I think in dollar terms or in constant currency terms, we think Europe will outperform because we have the dollar coming down. If you currency hedge, though, probably the US market with its tech stocks and its better economic growth.
Should I currency hedge?
Looks a bit better. Depends what type of asset allocator you are. Sometimes you should currency hedge, sometimes you shouldn't. Currency hedging is obviously a bit costly as well. It's not zero cost for you. And you can currency hedge by investing in the right markets as well.
Sharon, we're going to be talking a lot about geopolitics this week, UNGA happening in New York. You wouldn't know that there is so much geopolitical news by looking at the equity market. How are you thinking about it in terms of your equity outlook?
No, I agree. I suppose we've had so much uncertainty, and we still have, in our view, the tariff hit still really to come. And that's, to me, the biggest geopolitical risk, as it were, the impact of tariffs and the negotiations that you see globally still going on between the US and various countries. And even though deals have been reached with the EU and a few other places, you're still going to have an economic hit for the US, which takes place at the third or fourth quarter of this year. We do think this will take down US growth. But on the other hand, because the labour market softened, inflation has come down a little bit from its peaks, you can also cut rates into that, and that's helped the market really insure itself, save itself against some of these political risks.
Is stagnation bullish for equities globally?
No, I don't think it's bullish for equities, no. I think if you get stagnation, particularly if it comes with still high bond yields and high inflation, that's not a bullish environment for equities. But the market is not really pricing stagnation. It's pricing a little bit of a dip, followed by improvement in 2026 and 2027.
But where does that improvement come from?
Well, if you look at financial conditions in the US, they're pretty much the easiest they've been in the last 2 years. Why are the easiest they've been in the last 2 years? Well, bond yields have come down modestly. Interest rates have come down as well at the short end, and expectations are coming down. Credit spreads are very, very narrow, and the equity market has done well. All of those things, and the dollar's come down too, all of those things mean easier financial conditions. That helps you get better growth next year.
But Sharon, that's the market pricing in a very dovish Fed that the Fed doesn't agree to.
Yeah, I mean, we also expect 2 rate cuts this year and 2 more next year, largely because we do think there's going to be a tariff impact on growth in the fourth quarter. You'll see a little bit weaker growth as we go through the second half of this year and get the data for that. And then next year, with slightly easier policy conditions, you get slightly better growth next year. So there's not zero hit, there's some hit. But also, I think the market's looking through it because a lot of the market isn't super exposed to the US domestic economy. It's exposed to tech, AI, and other growth trends.
Where's the overlap between the tech trade and the and everything else? If the economy slows down, does tech get affected? Can I invest in tech regardless of the cycle?
Of the economy. Not regardless of the cycle. I think a slowdown in the economy, no recession, tech will shrug that off. If you get a recession, generally speaking, that's a very different thing. Tech and certain elements of it are quite cyclical, not all of them, but I think they would suffer. Final point on tech is that some of the biggest cap stocks, the ones we all know, the Mag 7, for example, excellent balance sheets. Yeah. So you could argue they've got certainly better balance sheets than many governments globally.
Sure.
So they're not
better off buying the credit.
They're not just US exposed, they're globally exposed. So they're not just dollar earners, they earn other currencies. They've got great balance sheets. As you say, credit spreads for a lot of, borrowing costs for lots of companies globally are actually lower than their own governments.
Yeah. Do I buy tech on a cheap dollar? A weakening dollar?
A weakening dollar is not bad for tech because, again, it's got a global footprint.
Sharon, great to see you. Thanks indeed for stopping by to see it. Not enough time, as ever. Sharon Bell, Senior European Equity Strategist, joining us from Goldman Sachs. Call 6 looked like this morning. What are we watching? We are certainly keeping an eye on what is happening with the defence space, but tech is interesting. The real divergence in tech this morning between some of the software companies and the hardware companies. ASML is up quite nicely. Schneider a little soft. Novo, was it in the FT this morning? I can't remember. It's in the Journal of the FT. I think it's in the Journal, talking about the fact that maybe actually the bottom could be in for some of the GLP-1 companies. Let's talk about that maybe another day, but come back to it. Novo this morning up by around 0.5%. Let's get some more moves with Chloe Melee.
Good morning, guys. So let's start with Porsche and Volkswagen that are down as expected today after slashing their outlook for 2025 and pulling back, hitting the brakes on that electric vehicle strategy. This is now the fourth guidance cut for Porsche this year, which has been dealing with a really low demand for luxury electric vehicles, but also a slowdown in China where there's a lot of competition and also tariffs, of course, weighing there. So that has been really dragging down the shares. We are down 6% for Porsche and almost 5% for Volkswagen, and probably also dragging down the shares of other European car makers. Moving on to the European airline sector, Lufthansa, IAG and EasyJet are also down, and that is on the back of the cyber attack that disrupted airport operations across the weekend, across Europe this weekend, in Brussels, London and Berlin. This is disruption that is likely to continue today as well, and is forcing the manual processing of passengers. So this is dragging down those shares this morning. Moving on to Sabadell and BBVA, which are also down this morning. BBVA increased its offer for Sabadell, now valuing it at 17 billion euros instead of a previous offer that valued it at 15.5 billion. This is something that the market is reacting quite negatively to, and Sabadell is down 3.2% and BBVA 1.6% this morning. Moving on to Tate and Lyle, which is a maker of sweeteners for the food and drink industry. It was cut to an underweight rating at Morgan Stanley, and that is dragging down the shares. We are down 4% for Tate and Lyle. And finally, ASML was rated at Morgan Stanley, but it was raised to overweight, an overweight rating, and that is driving up the shares this morning. We're up 2.9% for the semiconductor equipment company this morning.
All right, Chloe Melee from our equities team, we thank you so much with those movers. You mentioned Volkswagen and Porsche. Indeed, autos are the worst performing sector in Europe this morning, down 2.25%, and that tracks with what's happening in Germany. It's the underperformer across the continent. The DAX down 0.4%.
Kind of makes sense, isn't it? Let me put my Matt Miller hat on for a moment.
It's scary, that thought.
Porsches are meant to make a nice noise. And if it's an EV, they don't. And honestly, I think that's where it stops. You can buy any EV, the performance is sensational, and they are very quick, and you get a lot with them. Why do I want to buy a Porsche EV? I don't know. That's the question. And clearly people are answering with, we don't. Yeah. So Porsche going, you know what? Actually, we need to make cars that make a noise. And we're going back to ICE engines.
What is a midlife crisis without the purr of a Porsche?
Well, precisely. I'd love to go back to the air-cooled ones, but that's a whole different story. But yeah, I think it's about the noise, and they don't make this is a problem.
You're doing an incredible Matt Miller impression. That's all he talks about, the noise that cars make.
I know. This is why,
Right on brand, and you've nailed it. I mean, the takeaway, I think, for our audience is basically no one's buying luxury cars anymore.
Well, no, I think they're not buying EV. I think the 911, I try and get hold of one of those. It's really difficult, particularly with tariffs in the States. So trying to get hold of 911s is a different story.
Because the tariffs have made them even more luxurious, right? Because
precisely.
It's harder to get them.
And in some ways, sort of almost, I'm not sure Porsche gets into the Veblen good kind of sort of aura, the arena that Ferrari's in. But again, it's this kind of what does life look like for the luxury car makers in an EV world? Is there an EV world? What is the long-term story? If we're not ready to make the transition to a sports car that doesn't make a noise for most people, to your kind of like, do I want a midlife crisis without that noise? That's the soundtrack to a midlife crisis. I'm not sure midlife crises exist anymore, but I don't know. What is the long-term story for these businesses?
Well, you look at the analyst community this morning, and even the most bullish are saying that they're expecting some profitability deterioration further.
Well, they're going to take a hit because they went down the takeout route, and now they've got to come back sort of onto a different road, and that's clearly going to cost them some money.
Absolutely.
I don't know. A nice little burble, nice little kind of Porsche noise. You kind of need that. Can you fake it? I'm not sure.
Look, you need it. As a cyclist, I need to hear what's behind me when I'm on London streets. I really can't be doing with these EVs.
So Porsche sneaking up on you is not ideal.
No.
Well, I've learned so much.
Stumped.
I know. I have nothing to add. You guys have covered it. But I think what you need to take away here is that the shares are down some 5% for Volkswagen. And we're going to continue to monitor the auto sector. Oliver Kirk's going to join us later and walk us through some of the stories and details there. In the meantime, one firm eye on the banking sector as well. BBVA boosting the value of its takeover bid for Banco Sabadell. The story gets interesting. Stick with us. This is Bloomberg. Welcome back to the opening trade. About 19 minutes into today's session, right across the screen, the underperformer, no surprise, is the DAX. It's the auto sector that's very much in focus, but plenty of others that are driving the trade lower as well. Check out the IBEX. It's also trading lower, and some of that has to do with the banking news that we have gotten in just the last couple of hours. It's the deal that all Europeans are watching. BBVA raising the value of its takeover bid for Banco Sabadell by about 10%. It pushes the value of the deal to about 17 billion euros. Our Madrid bureau chief, Rodrigo Orihuela, is all over this story. Rodrigo, Sabadell management, C-suite, had asked for a 30% increase on the offer. How does this deal fare?
Well, there's two things that we have to bear in mind. One is that with their increase today, BBVA was very clear that they are not going to increase it any further because they said specifically they have waived that right. So this is definitely BBVA's final offer. The CEO of Sabadell is on a local Spanish radio speaking right now. Just before I came on to speak to you, he was saying that this is still a terrible offer. Any premium should be around for any bank about 30-40%. So he says this still falls well short of what they think their bank is worth.
So the offer's bad, the improvement's small, he says. Does that mean this is unlikely to happen?
Well, that is a bit trickier because basically last week, at the start of last week, Sabadell was trading above the offer price at the time by about 10%. As the week went by, that premium or negative premium reduced. It ended the week almost flat, about 5%. So now they are actually effectively offering to buy it for more than it closed on Friday. So the question isn't so much what the management think, which is dead set against it. It's more down to the institutional investors. Many seem to be keen to sell, and to retail investors who, in Sabadell's specific case, are huge. They stand between 25 and 45% of the total shareholders base. So the question there is, will those shareholders say, okay, this is it, I want to take it at this 10% increase, and that has to happen today or tomorrow? To be honest, it seems that this may be a winner for BBVA, but it is far from a done deal.
How long before we know? How quickly could this get wrapped up?
So we won't know for certain till around sometime between the 10 and 15 of October, which is, so the acceptance period ends on October 7, and then the regulator has a few days to do their math and release information. So that is when we will have the final response. What we will have is indications in between, because certain sources start having access to the information as they compile it. But we won't have a definite answer for another 20 days, 25 days.
OK, we're on tenterhooks. Rodrigo, thank you very much indeed. Our Spanish bureau chief, Rodrigo Orihuela, joining us on the banking story. What's it like flying out there this morning? And is it going to get better? There's a couple of stories that we need to focus on from the aviation space. The UK government has approved a second runway at London Gatwick Airport in Prime Minister Keir Starmer's latest bid to lift the UK economy through major infrastructure works. This, of course, comes as Heathrow, Brussels, Berlin airports hit over the last few hours, few days by a cyber attack, which we still haven't recovered from. Let's bring it all together. Benedict Cameron leads our global aviation team. He's here to update us. Let's talk Gatwick first of all, and what is happening at Gatwick. So Gatwick, in theory, has 2 runways already. The problem is, though, they're too close together. We're now going to put them a little further apart. How easy will this be, and what impact do you think it's going to have at Gatwick?
So Gatwick is fairly confident they can do this in a relatively short amount of time for a relatively minimal amount of money. If you compare it to what's going on at larger Heathrow, we know there that they want to have that additional runway, the third runway, which has been long in the making and long in the planning, and God knows when it will happen. The Heathrow runway, just to give you some perspective, is supposed to cost about just north of £20 billion. The Gatwick airport runway would only be just north of £2 billion, so a tenth of that. They hope to have that ready by the end of the decade. As we all know, these projects are rarely on time, rarely within budget, but that is the plan at the moment, and really Gatwick trying to position itself as a viable alternative to Heathrow, which still really sucks most of the oxygen out of the UK aviation space. But Gatwick really thinks with that additional runway, they can claim a bigger stake here.
Benny, walk us through some of the updates around the delays that we were expecting. Berlin, Heathrow, Brussels, are they all back to normal?
It seems to be largely back to normal, but this was not a good weekend for travel. As you mentioned, we had disruptions at Heathrow, at Berlin Airport, in Brussels. And here in Berlin, it was a very busy weekend for travel because we had the Berlin Marathon going on. So a lot of people were coming into Berlin over the weekend. People like Harry Styles, who apparently participated in the marathon. We don't know how he got out, but I hope he's back safe. But the disruptions were, it was annoying for people. What happened was there was a cyber attack on some of the equipment. Collins Aerospace is a maker of check-in and baggage handling equipment. That was disrupted, and as a result, a lot of people had to wait. The actual cancellations were not that many. We had about just north of a dozen cancellations from inbound and outbound flights, most of them at Heathrow. So in actual fact, the cancellations not that dramatic, but really the aviation industry in those airports sort of taken back to a very analog space. A lot of check-ins had to be done manually rather than electronically, and lots of long lines. But for now, it seems like the system is almost back to normal.
Benny, you've left us all with the image of Harry Styles on the only acceptable method of transport right now, on your feet, and he had quite an impressive time, I saw. But look, there was another reason for disruption this weekend, Benny, and that was from cyber attacks to typhoons. We're looking at Hong Kong Airport mulling closure. How much disruption could we see there?
So that's going to be a lot more dramatic. We are expecting the Hong Kong airport to probably close sometime tomorrow, and it might close for as much as 36 hours, which would be the longest stretch in recent history. There have been closures in the past because of typhoons. We've had closures, I think, in 2023 of about 20 hours. There have been similar closures, but this is an airport that is obviously a massive hub in the region. Cathay Pacific is the big carrier for that airport. They operate about, several hundred flights a day. There's about 1,000 flights, just north of 1,000 flights every day out of that airport. And for that hub to close for more than 24 hours, that is going to be hugely disruptive.
All right, Benny Camel, our Global Aviation Managing Editor, we thank you so much for that update. We are looking at European airline stocks suffering this morning as a result. The likes of Deutsche Lufthansa down 1.7%.
The producer in my ear just went, chat airports. I'm like... Okay.
Well, you can do that all day long. What are you talking about?
Planes, yes. Airports, a little less so. Shocker. Airport has technology issue. Problem lines... I think we're all quite used to that.
Look, coming up, we're going to be covering all things tech and equities with Cathie Wood, founder, CEO and CIO of ARK Invest. That conversation coming up next. This is Bloomberg.
Welcome back to the opening trade. 30 minutes into today's session, and it's getting worse. The sell-off continues. We started off the session about 30 minutes ago. Seeing a little bit of weakness, not this much. It's certainly accelerated since trading has started. The DAX down about 0.6%. That is your underperformer this morning. It is all about the auto sector. It's worth noting, though, the FTSE 100, which started off as our worst performer in the future session, now only down 0.1%, Guy.
Some of the mining stocks are doing relatively well on the FTSE 100. That's helping that market out. Let's talk about the internals and figure out what is happening in this market. Definitely the balance to the downside, 437 to the downside, only 148 up. Volume's actually reasonably good this morning. We're which is interesting. There is a tech effect. We're seeing that in the Visa story this morning, coming from the Visa story this morning. We'll come on to that in just a second. Let's talk about some of the 52-week highs and lows. Let's start off with some highs. ASML hitting a high. It's interesting. It is not... You're seeing quite a divergent story in the tech sector this morning. Some of the software companies, SAP, big footprint in the States, exposed to the Visa story, getting hurt this morning. But ASML on the hardware front, the lithography front, up by 3%. The miners are really where the action is, though, this morning. Fresnillo in the gold space is up by nearly another 4%. That trade continues. We were hearing from Chris Watling earlier on in the programme, though, talking about his concerns about whether or not we're in the fifth wave of the Elliott wave theory of that gold trade. Does that start to get priced back into some of the miners? But Antofagasta also in the similar kind of business, up by 0.7%. The downside, quick look at some of the downside stories. We're obviously keeping a firm eye on what is happening with the autos this morning. Porsche down, VW down. But Haleon in the consumer space, in the consumer pharmaceutical space is down. Diageo's also down. The spirits business continues to be hurt. We talked about this last week. LSEG is down by 0.3%, continuing another 52-week high on that stock story this morning. But it's interesting. It's autos this morning that are one of the biggest stories in the European market. We've also got this Visa story rippling through into the European software space, Lizzie.
That's what's happening in your markets, Guy. Here's what else you need to know this morning. France is set to recognise a Palestinian state later on today. It follows announcements from the UK, Canada, Australia, whose leaders all call it a coordinated push for a two-state solution. The move has drawn criticism from President Trump and from Israeli Prime Minister Benjamin Netanyahu, who both argue that it rewards Hamas and threatens Israel's security. Elsewhere, a group of senior US House representatives is in China for talks with President Xi Jinping's government, the first such official visit in 6 years. The US group is led by Democrat and former House Armed Services Committee Chairman Adam Smith, as the world's largest economies edge closer to a trade deal. And President Trump's $100,000 fee on new H-1B visa applications is triggering confusion for corporate America and for workers as well. The move is aimed at cracking down on what the White House calls abuses of the program, which they say undercuts American workers. So, Guy, you could see more revenues for the Treasury, but you could see a hit to the labour market. But the big question for us, is it an opportunity for European tech?
Will it be an opportunity for Indian tech as well? Chinese tech. Remember, the bulk of these visas come from India. I think 1 in 10 of these visas comes from China. Does some of that talent end up elsewhere? I think is a key question. You've also got the story related to Europe as well. Is there a ripple effect into some of the European names? SAP, for instance, big employer in the United States, big user to a certain extent of these visas, is down by circa 1% this morning. Though European markets just beginning to bounce right now, Kriti.
Absolutely. The H-1B visa story is a fascinating one, not only just from a tariff perspective, from a geopolitics perspective, but a lot of the mega cap tech companies that the world is exposed to relies on this. I'm just looking at some graphics here. Amazon, for example, the leader in that, followed by the likes of Microsoft, Meta, Apple, Alphabet, our favorite tech names. Let's go to one of our favorite tech investors. Cathie Wood, founder, CEO, and CIO of ARK Invest, joins us around the table to talk about this world. Cathie, we want to get into your tech investments. We want to get into your views, but we got to put this question to you around H-1B visas and this new application fee. What do you make of it? What's the impact?
Well, again, this is part of President Trump's negotiating process, and I think he's negotiating quite intensively right now with India. I think India would have the biggest impact here in terms of workers in the United States. So I think this is a little bit like tariffs, and it's going to capture all the headlines. And it's going to really take the oxygen out of the room, because there's a lot of really good fundamental activity happening in the United States relating to policy.
Well, a lot of that innovation, a lot of that Silicon Valley kind of goodness really comes from the talent and the labor pool. We've been talking about this for quite some time in terms of how do you train your engineers, you train Americans to do a lot of what Silicon Valley depends on foreign workers to do. Does this impact innovation in Silicon Valley, and does it impact mega cap stocks, tech companies that are dependent on this?
Well, from what we know of this administration, they ultimately want to keep students who have been educated in the U.S., foreign students that have been educated in the U.S., in the U.S. So really, I just think this is part of the negotiation with India. and that when all is said and done, we're probably going to loosen up the H-1 visa program.
But in the short term, is that going to have an impact on tech companies?
I think what it's going to do is force tech companies to do what they're already doing, and that is become more efficient. And the other thing to note is, coding is changing dramatically. The number of coding jobs and openings has dropped dramatically because of AI. All of us can become coders. You've heard of vibe coding.
She looked at me there, by the way.
I was going to say, that's a lot of faith in God.
This is natural language programming. Generative AI is prompting ChatGPT to get your programs going. We can all do that. That's simplifying it. But I do think it gives you a sense of the kind of productivity, that possibilities that are possible, that will impact these tech companies longer term.
Kind of takes me on to my next question. Is Chinese tech going to outperform US tech from a stock market point of view over the next year?
Well, the valuations are quite different. They're roughly half of what they are in the United States. We're very impressed at how quickly China is moving here. I think the DeepSeek moment gave us an opportunity to understand that China is very focused on the open source software movement. We forced them into that. The U.S. did, because our companies stopped selling into China out of fear of IP theft. So they've gone the open source route and are moving very quickly. I think competition is a good thing. It's a good thing for the United States. It's a good thing for China. I also think what's good about China recently is it is focused now on the idea that maybe commoditization has gone too far, especially in the electric vehicle space, so-called involution. They are thinking...
Whatever that means,
Whatever that means. So they're thinking that, and it is true, it is expensive to develop these large language models, even though they say it's not. There's a lot of pre-training that takes place before you get a DeepSeek. And if you're not profitable as a company, you're going to have a lot of trouble competing in that space. So I think even that is changing, which is interesting.
When does AI become profitable? When can I assume a margin on AI? And I'm talking about the large language model companies here. Huge amount of investment going in at the moment, Cathie, and everybody's scratching their head wondering, does all of it deliver? Does all of it produce a rate of return? Are we going to have to see some sort of Schumpeterian sort of clearing of the market at some point? What does that look like? What is your sense of kind of where we are at the moment?
Well, I think that the number of companies truly competing in the large language model space has shrunk. These acqui-hires that OpenAI and Meta, that's all about, other companies really not making it. So that...
so the process has already started?
The process has started, but in
Who do you think is going to win?
Well, I think the big four right now are OpenAI, Anthropic, xAI, and Gemini. Those four. And we don't know if this is going to be a 4-horse race or a 2-horse race. Let's see over time how they leapfrog one another, and they are doing that regularly. It's very interesting. But you ask about profitability. Companies that are not hiring people, the number of new job openings is falling. They are already enjoying huge productivity increases. That's why margins have been sustained even with the tariff hit recently. In fact, tariffs being put in place, the counter to that is, okay, we have to cut costs. And that has been, and they're willing to pay $20 a month. Some are willing to pay $200 a month. And those who are replacing PhDs, they're willing to pay $2,000 a month or more. And so as long as these companies get that signaling that companies are willing to pay, they will continue to invest in this race.
Cathie, you say competition's a good thing. We've talked about the landscape. Let's talk about you. Yes. There's a lot more tech, innovation, robotics, ETFs out there now. How do you plan to compete?
It's a great question, Lizzie. I think our differentiation is our research. We have what I believe is the first sharing economy company in the asset management space when it comes to research. We give our research away. We have given our Tesla model away, for example.
Deep-seek approach.
Yes, the open source from that point of view. I think we have a very loud voice out there when it comes to innovation. And I think some of the calls we've made, starting in 2015 with Bitcoin, and at the same time, roughly, Tesla, Palantir, Coinbase, NVIDIA, in the earliest days, we were there when most people thought it was a PC gaming chip company. So I think we've got a loud voice. You're asking about conversion because we have these other companies out there which with huge distribution. Well, thanks to Bloomberg, we are able to share with you our research, and it's research that others aren't doing in quite the same way.
But when you look at the numbers, ARC's up about 40% this year. Flows are absolutely flat. What can you do about that if great performance just isn't drawing people in?
Well, what's interesting about that is most active managers are outflowing today. So the fact that we're flat is very interesting. And what's more interesting to us and very gratifying, having entered UK and Europe, is that we are about to cross $1 billion here in Europe and the UK, which in 2 years' time, we acquired Rise 2 years ago, is very significant, I think. I think here in Europe, a quarter of our reader base, even before we launched, was in Europe. And the question was, when are you coming to Europe? So we are getting the flows here in the UK and Europe, and we're really excited about the momentum behind those flows.
Cathie, I want to get your take on a deal that was preliminarily announced on Friday between the United States and China when it comes to TikTok. Now, I think you're a unique person to have this conversation with, given your early exposure to Chinese tech stocks.
Yes.
TikTok has now been, we're still waiting for all the details, but we understand is being given 7 board seats to Americans. There's a question of a licensing agreement. There's a question of some of the holders, including the Murdochs or Larry Ellison, among others. What kind of precedent does that set for you as someone who is exposed to Chinese tech? Is this the new norm, or is this an idiosyncratic story?
I think this is idiosyncratic. I think during our election, President Trump promised that he would be open-minded to keeping TikTok U.S. It's so important to the young people and many more people in the United States. So I do think it's a one-off special case. I also think it's a part of a broader negotiation with China. I think if anyone can reenact a Nixon in China moment, it is President Trump. He has been toughest on China. Everyone trusts that he will strike a good deal. Everyone in the U.S. trusts he will strike a good deal with China. And I think we're probably going to get better than expected news longer term. You'll hear a lot of saber rattling in the meantime. But this is one indication of that.
Is TikTok a good investment if the U.S. has more hold over it? And counter to that, is ByteDance a good investment if this is a deal that's being created?
You know, the one question we always have when there is a breakup like that is, does a company lose some of the network effect in some way? Now, they were already supposed to be separate, China and the U.S. We'll see. We'll see. TikTok has been an amazing company, has taught us a lot. This is what I mean about Chinese competition. They taught our companies a lot. I will say that a company called Vine in the U.S. was the precursor, and Twitter at the time bought it, was not able to activate it in the way TikTok has, and TikTok ran away with that ball.
So would you want a piece of it?
You know, we have to do a deeper dive when we get into the data room.
Crypto's down a little bit. Bitcoin's selling off this morning. At these kind of levels, are you a buyer or a seller?
Well, we've been increasing our exposure generally to the digital asset space. I think Bitcoin has been the leader of the pack. The others are following. Ether has followed. Now Solana. And Hyperliquid is a new one, the new kid on the block. We think this is 3 revolutions in one: a monetary revolution, a financial services revolution, and really, in a much broader sense, a digital property rights, immutable property rights online. Never happened before, only possible because of blockchain technology.
Okay. Down by around, crypto's down, well, the Bitcoin's down around 2% this morning. Cathie, great to see you. Thank you very much indeed. Cathie Wood, founder and CEO of ARK Invest. Coming up, what are we going to be talking about? We're going to take you back to the car story. Volkswagen under pressure, Porsche taking a hit on what is happening with the rollout of EVs and maybe a retrenchment back to ICE engines. We'll talk about that story next. This is Bloomberg.
Welcome back to the opening trade. We're 49 minutes into today's session, and it's read across the screen, particular underperformance out of Spain, and that comes down to the Spanish banking story, but also for the DAX in Frankfurt, down 0.7%. The worst performing sector is, in fact, autos, and that comes down to the Porsche VW story. You've got Porsche shares currently down about 7.4%, Volkswagen down 6.4% as things stand. So let's get some details on that. They have cited a €1.8 billion hit to operating profit linked to delayed EV rollouts. We could bring in Bloomberg's Oliver Crook for more now. Ollie, just break down what's actually happening here at Porsche.
Yeah, I mean, it bears sort of lingering a little bit on some of these numbers. You mentioned a profit hit of 1.8 billion euros, which is obviously mammoth. What that is going to hit are the margins. And of course, the margins are the all sort of important metric that we look like when we evaluate luxury car companies like Porsche. They're seeing now for this year a margin of 2%. Now, if you're getting 2% margins on selling basically a race car, there is certainly a massive problem. We should put for comparison, just 2 years ago, those margins were at 18%. The year before that, they were at 18%, and those have come steadily down, steadily down, steadily down. Now cutting it, they were originally going to get 5 to 7% on their margins. They're now seeing 2%. They've also reduced their medium-term target, so that was supposed to be up to 15 to 17%. That is now 10 to 15%, and that is the fourth profit guidance cut of this year. So really coming at a very poor time for Porsche. In terms of what this is down to is basically this idea of you don't change horses in the middle of the stream. There is a back and forth on basically what the EV strategy is going to be for Porsche. As we know from the very beginning of the EV revolution, it's been kind of a black box to figure out what demand for electric vehicles is going to be. And now basically having to change your entire plan. And these are massive manufacturing supply chains and massive operations to basically figure out whether you're doing EVs, hybrids, or combustion engines. That is the big question. The question, I think, for investors today is where is the bottom for this? I mean, we're seeing now shares coming down, 5, 6, 7%. There's already a lot of bad news priced into these stocks. The question is going to be how much further is this going to go? Certainly today, investors do not have confidence that it's over.
And that's the problem, is that the shift to EV, certainly at the upper end of the market, is a struggle. And you look at residuals on Taycans and how much the cars are worth kind of a year, 2 years, 3 years down the road. It's a huge problem. What does this tell us about what is happening in the wider auto sector? What is the message from VW for everybody else this morning?
Well, listen, it's dragging the rest of the sector down with it. But if you just take a step back and you just look year to date for what is going on in the European car sector, and I think we've got the chart here for you, you look at what we've seen so far. Stellantis down 34%, Porsche down 30%, Renault down 25%, Mercedes-Benz down 7%. And really the only winner in Europe has been BMW, and they're up only 2.5%. And we give credit where credit is due. And I think for the question for investors is what is going to be the compelling story here? What is going to be the sort of viable story from Volkswagen in order to turn this around? Remember, Volkswagen, had sort of prepared investors for some very rough times ahead. Volkswagen had committed to spending 180 billion euros in terms of R&D to develop their EVs and their digitalization. Just for sort of context, that is more than twice the German military budget this year. That's what VW is going to spend over into 2028. So now I think there are two big questions here that opens for the auto sector more broadly within Europe. One, we are still staring down the barrel of this 2035 EU combustion engine ban. That is still in place. Massive debate about what this is, whether or not this industry is prepared for that. You're going to have that debate much more going on in Brussels. And then the question, of course, is cost cuts at Volkswagen. There was that massive push to cut costs last year. A lot of analysts and people that I spoke to said they had not gone far enough. Now that we're seeing, margins come out at 2% for Porsche, I think there's also going to be a conversation about more job cuts possibly, and certainly finding ways to reduce costs at Volkswagen.
All right, Bloomberg's Oliver Crook walking us through the auto story and teaching me a new phrase. Don't change horses in the middle of a stream. Didn't know that one. Thank you so much. Let's go into the week book here. Plenty going on this week ahead. The BOE's Bailey speaking at a fireside chat at the London School of Economics. So monetary policy very much at the forefront today and throughout the week, I should say. We're awaiting Chairman Powell's comments, I believe, tomorrow. PCE data later in the week. And then, of course, UNGA throughout the week as well. So really setting the stage for quite a bit of geopolitics.
Absolutely. I'm quite interested in the IFO number. Just come back to that kind of story around what's happening with Germany. I think it's IFO Wednesday. And it's going to be interesting to see, on the one hand, you've got the fiscal story, what's happening with the defence spend, but also just the chaos that is happening in the auto sector and the chemical sector right now. What's Valerie Teitel watching this week? Powell tomorrow? Is that going to be exciting?
Look, we not only hear from Powell tomorrow, we also hear from Michelle Bowman, who was at dissenter 2 meetings ago and failed to join Miron this time around, voting for a bigger a 50 basis point cut rather than the 25 they went with. But Powell's comments might be key here with the background of what's going on with this H-1B move by the Trump administration, whether that complicates the view on the labor market, or perhaps in his mind, is he just thinking this is a negative impact on GDP growth and maybe another reason to continue cutting. It's going to be very interesting to see whether his gut reaction is whether this is going to hurt growth or if this is going to tighten the labor market, because that's policy in two different ways. Perhaps, but one is going to have a more lasting effect. One is going to have more lasting effect, whether that's growth or on the labor market is a good question to ask. But it's interesting also to see we have, the Mag 7 stocks might be weighing on the NASDAQ this morning on the back of this H-1B. Remember, they're heavy users of the H-1B visas, and that's probably the reason why we're seeing the NASDAQ, be so heavy this morning. But again, is that really going to change the dial for some of these companies? It'd be interesting to hear from them if we do this week on their thoughts on H-1B. Cathie Woods, though, she was just on set. She's reading into it more of a negotiation with India rather than maybe a move by the Trump administration to tighten immigration policy.
Yeah, it's fascinating. At the very end of that conversation with Cathie, we also got her take on crypto. It's weakening today. Just walk us through that.
Weakening today, there is some chatter about a heavy liquidation when it comes to Ether. Ether was actually the crypto coin that was moving most of the market this morning. It was down over 6%, which has led XBT, Bitcoin, to drop 2% in a straight line. Maybe that's adding some weakness onto tech stocks rather than the H-1B narrative. But interesting to watch that story because it's happening alongside gold hitting a fresh record high.
Are you suggesting that there's a correlation between crypto and tech stocks?
Perhaps this morning, or is it the H-1B? We don't know. But, you can add gold into all of this, right? There might be a clear reason why someone wants to be buying gold rather than crypto this morning.
You know what's slightly stronger? The dollar. Just a little bit, just for a minute. Bloomberg's Valerie Teitel walking us through some of those market moves. We thank you so much. I think what you need to know here is that there's weakness across the board. You're seeing it on both sides of the Atlantic. Certainly the auto sector and the banking sector very much in focus. That does it for the opening trade. Pulse is up next. Stick with us. This is Bloomberg.